Inventories have trended structurally downward across multiple reporting cycles. At the same time, margin requirements on silver futures contracts increased by approximately 30% within a compressed administrative window. This analysis reconstructs how a technically neutral risk adjustment intersects with an already imbalanced physical to derivative structure. In early June, the primary derivatives venue governing silver futures implemented a margin increase affecting both initial and maintenance requirements for standard contracts. The adjustment applied uniformly across clearing members, proprietary desks, and leveraged participants. No distinction was made between speculative or hedging classifications, and no emergency designation was invoked. The increase followed standard internal risk models and was communicated through routine clearing notices. The change resulted in an immediate rise in collateral demanded per open contract, recalculated nightly through variation margin mechanisms. Trading continued uninterrupted, contracts remained fungible, and settlement procedures were unchanged. No delivery rules were modified, and no force majeure language was introduced. Public documentation confirmed the percentage adjustment without qualitative justification beyond volatility, normalization, and risk containment. From an institutional perspective, the environment surrounding the adjustment appeared administratively stable. Open interest remained elevated, daily volume cleared without disruption, and benchmark spreads across maturities showed no discontinuity. Clearing members processed margin calls through established liquidity channels, drawing on cash buffers, credit lines, or position reductions as required. Market makers continued quoting two-sided liquidity, and official statements framed the increase as a routine recalibration. To an external observer, nothing in the operational flow suggested stress, urgency, or deviation from historical precedent. The system functioned as designed. Yet within that stability, a subtle reweighting occurred. Margin is not a price mechanism. It does not express valuation, expectation, or directional bias. It is a gatekeeping variable that determines who can remain positioned and under what capital efficiency. By altering that variable, the exchange modified participation density without altering the instrument itself. The contracts did not change. The metal did not change. The accounting of risk, however, did. The central question is not why margins were raised. Margin increases are common, cyclical, and procedurally justified. The more structurally relevant question is which balance sheets are structurally compatible with a higher collateral regime in a market where paper exposure vastly exceeds deliverable metal, and which balance sheets are not. At this point, it is necessary to state the analytical limits of what follows. This reconstruction does not assert intent, coordination, or outcome certainty. It does not forecast prices, delivery events, or institutional actions. It documents structural relationships, administrative mechanics, and balance sheet asymmetries observable in public data. No actor is assigned motive beyond institutional constraint. Following the initial adjustment, clearing members recalculated margin to equity ratios across their client books. For participants operating with high leverage and thin liquidity buffers, the increase translated into immediate capital calls. These were not punitive, but arithmetic. Each open contract now required more non-negotiable collateral. Participants unable or unwilling to allocate additional capital faced a binary choice: reduce exposure or exit positions. Larger entities with diversified funding sources absorbed the increase with minimal friction. Smaller speculative accounts, particularly those expressing directional exposure without offsetting physical positions, faced a materially different constraint profile. This is where the margin mechanism intersects with market structure. Silver futures are predominantly cash-settled instruments, but they retain an embedded delivery option. That option is rarely exercised, yet its existence anchors the derivative to the physical system. When leverage is cheap, the distance between paper exposure and physical availability can widen without consequence. When leverage becomes more expensive, the distance becomes economically relevant. As margins rose, open interest began to compress modestly, not uniformly, but selectively. Reductions clustered in shorter-dated contracts and among participants historically sensitive to funding costs. Meanwhile, entities operating as commercial hedgers, or those with integrated physical flows, exhibited greater persistence. This divergence was not ideological. It reflected balance sheet architecture. The silver market has historically oscillated between periods of abundant leverage and periods of constraint. Each transition reorders participation without announcing itself as such. Margin adjustments are one of the few levers capable of doing this quietly, within rules and without narrative disruption. They do not force outcomes. They enforce compatibility. At a deeper level, the margin increase interacted with inventory classifications. Registered inventories represent metal available for delivery against futures contracts, while eligible inventories are metal meeting exchange specifications, but not pledged for delivery. The ratio between open interest and registered inventory has remained elevated. This does not imply imminent shortage. It implies dependency on rollover behavior. As long as contracts are rolled forward and settled financially, the system clears. That behavior, however, is sensitive to funding costs. By increasing margins, the exchange effectively increased the cost of maintaining paper exposure across rollover cycles. For participants rolling large notional positions, this compounds. Each cycle requires sustained capital allocation. Entities whose exposure is functionally synthetic, unanchored to physical throughput, experience this as friction. Entities whose exposure offsets physical production, fabrication, or inventory management experience it as a cost of doing business, already internalized. The result is not a transfer of wealth in the conventional sense. It is a redistribution of positional persistence. Some positions become structurally harder to carry. Others remain viable. Over time, this shapes who remains when volatility compresses and who is forced to disengage when it expands. It is within this framework that the question of who wins must be reframed. There is no discrete victory. There is alignment. Participants whose capital structures, time horizons, and operational models align with higher collateral intensity remain. Those optimized for low-margin environments gradually recede. The exchange does not select winners. It enforces arithmetic. Historically, similar adjustments have preceded phases of reduced speculative density, followed by periods of lower open interest but higher concentration among fewer larger holders. This is not unique to silver. It is observable across commodities where physical constraints exist but are mediated by financial instruments. The margin mechanism acts as a filter, not a signal. As the market continues to process the adjustment, attention shifts from the event itself to its second-order effects. Position composition changes before price does. Liquidity thins selectively. Volatility may compress or expand depending on which participants exit. None of this violates market neutrality. It is the natural outcome of capital requirements interacting with heterogeneous balance sheets. In this context, the margin increase is less an isolated administrative act and more a point of contact between abstract risk models and tangible constraints. It exposes the difference between exposure that can be financed indefinitely and exposure that depends on continuous leverage accommodation. That difference has always existed. The margin adjustment simply made it visible. What follows next is not a conclusion, but an extension of this framing into broader historical and structural cycles. The silver market has encountered similar inflection points before, each time under different macroeconomic conditions, regulatory environments, and inventory regimes. The present case does not replicate the past, but it resonates with it. Understanding that resonance requires stepping back from the immediate mechanics and situating them within a longer systemic arc. The contemporary silver market does not exist in isolation. Its current configuration is the cumulative result of decades of financialization layered onto a finite physical substrate. To understand why a margin adjustment propagates structural consequences, it is necessary to situate the present configuration within that longer arc, not as a sequence of events, but as a recurring pattern of constraint, expansion, and recalibration. Since the late 20th century, silver has increasingly functioned as a hybrid instrument. It is simultaneously a monetary metal with historical reserve functions, an industrial input embedded in manufacturing supply chains, and a financial asset abstracted into derivative form. Each of these roles imposes different temporal and operational demands. Industrial users require continuity of supply and price stability within narrow bands. Financial participants seek liquidity, leverage, and optionality. Monetary holders emphasize custody, durability, and counterparty minimization. The futures market sits at the intersection of these roles, mediating between them without fully satisfying any single one. Over time, the growth of derivative volume has far outpaced the growth of physical inventories. This divergence was not accidental. It reflected deliberate design choices intended to enhance liquidity, improve price discovery, and accommodate global participation without requiring proportional increases in vaulting capacity. As long as most contracts were rolled forward or cash settled, the system functioned efficiently. Physical delivery remained a backstop rather than a norm. The credibility of that backstop, however, depended on confidence that it would not be widely exercised simultaneously. This is where margin policy becomes historically relevant. In periods of macroeconomic stability and low volatility, margin requirements tend to drift downward relative to notional exposure. Leverage expands, participation broadens, and paper claims multiply. In periods of stress or transition, margins rise, leverage contracts, and participation narrows. Each cycle resets the composition of the market. The present increase fits squarely within this historical rhythm. Looking back, similar adjustments occurred during periods of monetary tightening, supply chain disruption, or regulatory transition. Each time, the stated justification focused on volatility management and systemic risk. Each time, the deeper effect was a redistribution of who could afford to maintain exposure across time. The silver market's sensitivity to these shifts is amplified by its relatively small size compared to other major commodities. Incremental changes in capital requirements therefore exert outsized influence on participation density. What distinguishes the current environment is the simultaneity of multiple constraints. Industrial demand for silver has expanded structurally due to its use in electronics, photovoltaics, and specialized alloys. This demand is not speculative and does not retreat quickly in response to price fluctuations. At the same time, mine supply growth has remained incremental rather than exponential, constrained by geology, permitting timelines and capital discipline. Recycling contributes meaningfully, but is also price-sensitive and temporally lagged. The physical side of the system, therefore, exhibits limited elasticity. Overlaying this physical backdrop is a financial layer optimized for flexibility. Futures contracts, options, and exchange-traded products allow exposure to be scaled rapidly without corresponding movement of metal. This asymmetry is functional until it encounters a binding constraint. Margin is one such constraint. It does not directly limit quantity, but it limits duration. It asks a simple question repeatedly: can this exposure continue to be financed under current conditions? To answer that question, it is useful to model the market in stages rather than events. In the initial stage, leverage is abundant and inexpensive. Participants accumulate exposure based on expectations, correlations, or portfolio strategies. Physical inventories serve as a distant anchor. In the second stage, volatility increases or policy shifts prompt a recalibration of risk models. Margins rise, funding costs increase, exposure becomes more expensive to carry. In the third stage, participants self-select. Those with structural reasons to remain reduce leverage but maintain presence. Those without such reasons reduce or exit. The present margin increase appears to mark a transition between the second and third stages. It does not resolve imbalances, it surfaces them. The open interest to inventory ratio does not collapse overnight. It adjusts gradually as rollover behavior changes. Contracts are closed, consolidated, or transferred to entities better equipped to absorb collateral demands. This process is slow, procedural, and largely invisible outside of aggregate statistics. Importantly, this stage-based model does not imply an endpoint where the system fails. It implies oscillation around constraints. The silver market has repeatedly demonstrated its capacity to adapt through administrative adjustments rather than abrupt discontinuities. Margins, position limits, and delivery rules form a toolkit for managing stress without suspending function. Each tool redistributes pressure rather than eliminating it. Within this framework, the question of inevitability must be handled carefully. There is no predetermined outcome encoded in a margin increase. What is inevitable is that capital-intensive participation becomes more selective as collateral requirements rise. This selectivity favors entities with diversified revenue streams, lower funding costs, and operational integration. It disfavors entities dependent on short-term leverage and narrow spreads. This is not a moral judgment. It is a balance sheet reality. The structural model extends further when considering the role of clearing members. Clearinghouses intermediate all trades, guaranteeing performance while mutualizing risk. Their primary obligation is to maintain system integrity, not participant profitability. Margin adjustments are one of the few levers available to them that act preemptively rather than reactively. By increasing margins before defaults occur, they reduce tail risk. This shifts the burden of adjustment onto participants while preserving continuity. From this perspective, the margin increase can be seen as a signal not about price direction, but about tolerance thresholds. It indicates that existing exposure levels, when combined with prevailing volatility and inventory configurations, approached internal risk limits. Raising margins resets those limits. The market then re-equilibrates around them. This re-equilibration has implications beyond the futures exchange. Over-the-counter derivatives, structured products, and synthetic exposures often reference exchange prices and margin conventions. As exchange margins rise, funding costs propagate through these linked instruments. The effect is cumulative. Each layer adds friction. Over time, this can dampen speculative amplification while leaving industrial hedging relatively intact. None of this implies that volatility disappears. It implies that volatility is borne by fewer, better capitalized participants. Concentration increases even as notional exposure decreases. This can create the appearance of stability while masking underlying tension. The system appears calm, not because imbalances are resolved, but because fewer actors are carrying them. At this stage, the analysis transitions from historical pattern to mathematical constraint. The relationship between open interest, margin requirements, and available collateral is not subjective. It can be expressed in ratios, funding costs, and opportunity costs. When those ratios cross certain thresholds, behavior changes, regardless of sentiment or narrative. The next section examines that arithmetic directly, not to predict outcomes, but to show why certain configurations cannot persist indefinitely under higher collateral regimes. The advanced stages of the structural model emerge only after the initial filtering has already occurred. At this point, participation is no longer broad. It is concentrated among entities whose balance sheets can tolerate prolonged collateral commitment without relying on favorable short-term price movement. This concentration alters market behavior in ways that are subtle but persistent. In earlier stages, price fluctuations are amplified by rapid position changes. Leverage enters and exits quickly, responding to marginal incentives. In advanced stages, exposure becomes more static. Positions are larger, held by fewer participants, and adjusted less frequently. This reduces headline volatility while increasing underlying rigidity. The market becomes less responsive to incremental information and more sensitive to structural shocks. This rigidity is not inherently destabilizing. In fact, from a clearing perspective, it is often preferable. Fewer participants with higher capital buffers reduce default risk. However, rigidity introduces a different constraint: reduced flexibility in responding to changes in physical flow. When inventories shift, production schedules change, or industrial demand deviates from expectations, the financial layer adapts more slowly. The system remains solvent but less elastic. As margins remain elevated, the cost of maintaining large paper positions compounds across time. This does not force liquidation, but it forces prioritization. Capital allocated to silver exposure is capital not allocated elsewhere. For diversified institutions, this becomes a portfolio optimization problem rather than a directional bet. Exposure is retained only if it serves a specific hedging, inventory, or strategic function. Purely opportunistic positioning becomes increasingly unattractive. At this stage, convergence occurs not through price discovery alone, but through capital discipline. Exposure aligns more closely with underlying physical activity. This does not mean that paper claims equal physical supply. It means that the gap between them is carried by entities capable of absorbing it indefinitely. The system stabilizes around that configuration until conditions change again. The mathematical constraints underlying this process are straightforward. Each futures contract represents a fixed notional exposure. Each contract requires a fixed margin deposit that scales with volatility. The total margin burden is therefore the product of open interest and margin per contract. When margins rise, the same open interest demands more collateral. If total available collateral within the participant base is finite, open interest must adjust downward or concentrate among those with excess capacity. This relationship does not depend on expectations about price direction. It depends on balance sheet arithmetic. Even if all participants agree on valuation, they cannot all maintain exposure if collateral requirements exceed aggregate capacity. Someone must reduce exposure. The margin mechanism determines who. The impossibility emerges when considering rollover dynamics. Futures markets rely on continuous rollover to maintain exposure without delivery. Each rollover incurs transaction costs and requires margin continuity. As margins rise, the cost of rolling increases. Over long horizons, this cost becomes non-trivial. Positions that are not offset by physical flows accumulate, carrying costs that cannot be eliminated through strategy. They can only be absorbed or abandoned. This is where the system does not close mathematically. A market configuration with persistently high paper-to-physical ratios assumes indefinite willingness to finance that ratio. Margin increases test that assumption. They do not break it immediately. They erode it gradually. Over time, exposure migrates toward entities for whom the financing is incidental rather than existential. Looking forward, the timeline that follows such adjustments is not linear. There is no single outcome or date. Instead, there are scenarios bounded by constraints. In one scenario, margins remain elevated and volatility subsides. Participation stabilizes at a lower, more concentrated level. In another, volatility increases further, prompting additional margin adjustments and further consolidation. In a third, external factors such as monetary policy shifts or supply disruptions alter the risk calculus, leading to recalibration in the opposite direction. Across all scenarios, one constant remains. The system continues to operate. Contracts clear. Deliveries occur when demanded. Most exposure remains financial rather than physical. The difference lies in who carries that exposure and at what cost. Risks and counterpoints must be acknowledged. Margin increases do not eliminate speculative excess. They can be reversed. Inventories can be reclassified. New participants can enter with fresh capital. Technological changes can alter demand profiles. None of these factors invalidate the structural analysis. They introduce variability around it. The framework describes tendencies, not certainties. It is also important to note that margin policy is reactive as well as proactive. Clearinghouses respond to observed volatility and stress. They do not operate in a vacuum. A margin increase reflects conditions that already exist as much as it shapes future behavior. Interpreting it as a unilateral imposition misses this feedback loop. In closing, the growth in silver margins is best understood not as a signal of intent or outcome, but as an adjustment point within a long-running system. It reveals which forms of participation are structurally aligned with higher collateral intensity and which are not. Those aligned persist quietly. Those misaligned exit without ceremony. No announcement is made, no winner is declared. The story, therefore, is not about silver alone. It is about how financial systems manage imbalance without resolution, using procedural tools to redistribute pressure across time and balance sheets. Monitoring these tools, rather than reacting to narratives around them, provides a clearer view of how such markets evolve.